I mean, usually I've found that the best managements don't really talk about the share price at all, unless obviously things are stupidly cheap and they're allocating capital and doing buybacks. But it tends to be about how they're doing operating the business, and the share price is a secondary consideration to some degree.
Hi, so I'm here on Zer0es with Jules Hull of StockViews, a UK-based independent research house. Jules, thank you very much for coming on today. Really great to have you on the show.
Yeah, hi Freddy. Honoured to be included in some of the stuff you guys are doing. Obviously, we've always been big admirers, so yeah, looking forward to chatting.
Yeah, to kick things off, I've followed your work for a number of years. Both when you were putting out sort of more traditional pieces and kind of the independent sell-side equity research frame, but also, the more modern approach you've taken with a quantitative view. But really, I'm interested in, how you got here, in terms of your career and where you started in the investment business.
Well, I originally I was about to do law, and I was all set to do a training contract at one of the sort of city law firms, and I had a day in the floor of Bear Stearns. I think it was the first day of the real beginning of the crash. Yeah, it must have been August 2007. And I think some hedge fund had just blown up, or so there was the beginning sort of palpitations. The market was down about 3 or 4%, I think, on the day. I mean, I barely knew what an equity was at the time, but it was having done a training contract and sort of, been in a legal world where missing a full stop mattered more than your life. The dynamism of the equity trading floor at Bear Stearns while things were melting down was really quite exciting. So that sort of made me rapidly change course. I cancelled my law school fees and then very quickly sort of set about trying to get into the equity world. And about a few months later, I had started at what was then really quite a small, young, aspiring firm called Redburn, which was a research-only firm. And I guess maybe it's my personality or whatever, but I mean, I was at Redburn for 10 years or so. And back then it was a sort of, not a startup per se, but it was trying to do things a bit differently and take a purist approach to research. And I was there and learned under some great people. And there was a real sort of, stock picking mentality at the core of what they were doing to begin with, and that was really exciting and sort of learned my craft there. Things progressed, the industry progressed somewhat, and I sort of came across and got in touch with StockViews and Tom, who's one of the co-founders, and what they were trying to do just sounded so interesting and compelling at the time and also MiFID was just about to sort of kick in, and it was, they were trying to think about the real value of where fund managers would look in terms of trying to find alpha and trying to be really focused with your research instead of just having this waterfront coverage, which is what everything had become.
When you were at Redburn, you guys were employing the the kind of impartial sell-side equity research. You weren't backed by a bank.
Yeah,
there was no banking business. The entire model was commission-driven.
It was the big independent at the time. I think the model has moved on a little bit from here, but it was purely a research-based business, which it gave it both a purity of approach, which the clients liked, but then in the world of MiFID, as research, revenue started to be cut, and the spend that people were allocating was under intense scrutiny. That became a bit of a problem, I think, and also you suddenly had the corporate advisory take off, and this is something that we've tracked a bit. So in the incentive world and in the sell side and the analysts, you had something like back in early 2010s, probably 50% of revenue was coming from equity research and trading, Whereas now across the especially in the UK, amongst the UK players and the UK mid cap players, it's probably now only 5% of revenues come from the pure equity slug. Trying to do that pure equity analysis and why you're doing it has become totally warped, because ultimately what most of the revenue that pays for your bills, if you're an analyst, any normal sell side institution, is around corporate advisory and brokerage and other things. But yeah, no, Redburn was purely independent, and what attracted me to StockViews and what we're doing and have always tried to do is have this very pure philosophy of just being a sort of fee driven, from very simple top line, revenue, subscription fee model basically, that clients pay for.
I want to talk a little bit about your approach as an analyst. Did you have a sector coverage? How would you find new stocks to cover? What was your diligence process before you picked up coverage? How did that all work?
So I was on the sales desk at Redburn, which was always very idea driven and uniquely close to the analysts in terms of idea generation and discussion. And I think that was one of the great things that really worked for it during that time, is there was quite a lot of interaction and thought around how new ideas were generated and what they would be looked at. Ultimately, because of the way the fee structure worked and clients worked, you would tend to want to cover larger companies because you had a trading arm alongside you as well. And I think one of the things that again was very attractive and is exciting about the world of going slightly lower down the market cap scale and focusing in the mid cap, which is what we do now, is that there's a paucity of research there, and it's a growing paucity, and it's badly incentivized and skewed. And so you have a situation where there's just less people looking at these companies in the way that you'd want to be sort of analyzing them, and that's sort of the opportunity, because it's just not particularly, if you're a large brokerage firm or you're a sell side analyst, ultimately you want large clients to be able to trade your stock. Otherwise you won't get voted, you won't get points, you can't, the corporate advisory, the whole thing sort of compounds itself. So and in a MiFID world, that's become even more extreme, I think.
So we talked about the time you spent, or I think it was a day you spent on the trading floor at Bear Stearns, watching the world fall apart. Beyond that, how much time did you spend on the short side, or the hold recommendation side at Redburn, and how much of your client coverage was geared up to finding short ideas?
Well, it was, I guess what was quite interesting was that we had more sell recommendations than most people at the time, because again, it was an independent research firm. But even then, you had a slightly difficult situation where you didn't want to upset companies, so there was a balance between wanting to maintain coverage of companies, and analysts maintain a good relationship with those companies for corporate access and other reasons. Also, obviously, putting out pure research and having a clear view. And Redburn definitely started. It probably, in terms of conventional sell side, would blazed the trail to some degree in having many more sell recommendations. It was always quite a challenge, and it wasn't the sort of modus operandi of the firm. And indeed, most sell side research firms, you're not going to start out particularly thinking that sell ideas are going to make you a huge amount of money, because it's just very difficult sort of selling skepticism, as we know. But also the whole industry is geared around things getting bigger, the deals that flow off the back of that, growing assets, reinvesting those assets, etc., etc. So it's sort of counter to the mindset of your core clients to some degree, if you're a sell-side institution and trying to come up with sell ideas, because ultimately there are more clients who want buy ideas.
A lot of people on the sell side allude to the difficulties of engaging with management, so the lost corporate access. As people who don't engage with management, from our seat, I always wonder how I'd react, because if a short seller would approach me and they were just barking up the wrong tree or there was a misunderstanding in the business, I would have no real issue answering pointed questions. Really interested to understand how it works when you're in the room with the management teams, if they are challenged by the sell side, how you've seen them react, and how that influences the analysts.
Yeah, well, remembering back in the day, because we tend to do much less company interaction now and really focused on the analyst time on doing research. But back in the day, it would always be a slightly frosty reception that one would get if you had a management team in and you had a negative view. The management team would probably be, to some degree, trying to swing around the analyst or do their best to change that view. I mean, usually I've found that the best managements don't really talk about the share price at all, unless obviously things are stupidly cheap and they're allocating capital and doing buybacks. But yeah, in my experience, it's if I think back to some of the best management teams that I've sat in a room with and listened to, it tends to be about how they're doing operating the business, and the share price is a secondary consideration to some degree.
I think it's certainly throughout this cycle, from my perspective, I think management teams have become increasingly obsessed by the share price, and to a certain extent I actually think the buy side are somewhat complicit in that, because they're measured by performance of the stock, as it speaks to the share price. And I think there's a number of management teams that are seen as really caring about the share price more than the long term of the business. And in many ways, I actually think that is seen as a positive by some people on the buy side. Interested to hear if you think that has changed, or if that's just the perception from my seat.
Yeah, I probably don't have enough contact with management teams now to have a sense of that, but I would definitely agree that when you talk to investors in the buy side, there is a view that, well, if X or Y management team are particularly good at talking up their stock and they, that's their modus operandi, they're effectively management of the stock instead of management of the company. Whereas that might be a red flag for someone looking into why that's the case, from a sort of research perspective. To some degree in this environment, it's been encouragement from an investor perspective, because they'll probably get what they want. We've seen plenty of examples of that, where you have management teams now who are intensely focused on share prices. And to some degree, that's probably because they know that, as valuations get super extended and more divorced from the fundamentals of the company, that, it increases the need to do that. So that narrative, I was listening to a very good narrative discussion with Ben Hunt and Grant Williams, I think, on a podcast. And they were talking about how when the narrative of the company or the stock becomes the stock itself, that's when you have you're in sort of serious hyperbolic territory. And it definitely feels that way with a number of companies now.